When it comes to investing in the stock market, there is a slew of different strategies and approaches one can take. Do you want to be more of a hands-off investor? Then you can focus on ETFs and index funds. Are you looking more for those big home run gains? Then maybe individual stocks is more your style. Or you can have a blended style as well. But just know that having individual stocks comes with more gain potential, but also comes with higher risk. When it comes to my investing strategy, I like to take a more balanced approach. The centerpiece of my entire portfolio is an S&P 500 index fund, and ETFs and index funds make up a huge portion of my portfolio. And then I like to sprinkle in individual stocks, primarily dividend-focused stocks. Dividend stocks come in all shapes and sizes. You can find high-yield dividend stocks, moderate yield dividend stocks, low yield dividend stocks, REITs, or lastly, my favorite, dividend growth stocks. I love building passive income, and when you mix a growing dividend with the power of compounding, you can earn major amounts of passive income over the years. In today's video, we are going to discuss 5 of my favorite dividend growth stocks to invest in. If that sounds great to you, then do me a huge favor and click that like button down below, as that is huge for the growth of this channel moving forward, and I truly appreciate it. With that being said, let's get started. Hey everyone, Mark here, back for another video, and if this is your first time joining us, welcome. Here on this channel, we like to focus primarily on dividend stocks and ETFs as ways to build long-term passive income. So if that interests you, then make sure you subscribe to the channel so you are notified anytime we drop a new video. Now let's take a look at 5 of my favorite dividend growth stocks to invest in. And what I like to consider a dividend growth stock is any stock with a 5-year dividend growth rate of at least 10% or more. The first dividend growth stock that we'll look at today is Costco, stock ticker COST. Many of you are probably familiar with Costco and frequent it quite often. I know my family does, and you can't beat that $1.50 hot dog and soda. But Costco is so much more. It seems like they have everything, and they have been firing on all cylinders over the past decade. During that time span, Costco has increased their market cap from roughly $50 billion to over $200 billion today. And Costco has performed quite well given these inflationary times that we are going through right now. However, shares are still down over 18% on the year, yet over the past decade, shares have climbed nearly 370%. The company has a very loyal customer base with strong renewal rates. Just a few weeks ago, the company released their most recent annual report, and what we saw in there was that the company grew its U.S. comparable store sales by 15.8%, comp sales in Canada grew by 15.2%, and the company overall, including international, grew 14.4%. If you take out foreign exchange and gasoline prices, the adjusted comparable growth for the year was 10.6%. Costco currently pays an annual dividend of $3.60 per share, which equates to a dividend yield of 0.77%. When it comes to dividend growth, Costco has increased their dividend for 17 consecutive years now, and they have a 5-year dividend growth rate of 13%. Although the company has a low yield on paper, the company is known to issue special dividends, which are one-off additional dividend payments they make when cash levels pile up. The company has made 4 special dividend payments over the past 8 years. The second dividend growth stock that we're going to talk about today is Starbucks, stock ticker SBUX. Starbucks happens to be one of the very first individual stocks that I ever invested in. And currently the company has a market cap of $100 billion. Starbucks is not only a leader in their space, but they're also a technology leader when it comes to their app. Many in the restaurant industry have tried to emulate something even close to that of Starbucks. During the pandemic, Starbucks was hit quite hard as many went through a lockdown, especially here in China and the US, which are the 2 largest markets for the company. But we are seeing many return to work, And that is reflected in not only the share price, but we're also starting to see that in the comps that Starbucks is turning over. On the year, shares of Starbucks are down 25%, but over the past 10 years, the company's shares have increased nearly 270%. Long-term leader Howard Schultz is back running the company on an interim basis, but during the company's most recent investor day, they did announce a new CEO that will take the reins officially in April of 2023. Starbucks over the years has been a cash flow machine with the exception of that pandemic period. However, the company has recovered as operating income has reached $4.7 billion over the past 12 months. The dividend has consistently climbed, and so has the dividend yield, which hovered around 1.5% in the early years a decade ago, but now sits above 2.25%. The annual dividend per share is currently $2.12, which equates to a dividend yield of 2.44%. The 5-year dividend growth rate for Starbucks is 14.4%, and the company has increased the dividend for 11 consecutive years and counting. Before we move on, let me tell you about a special promotion that Webull is running right now. If you go and open a new account with Webull and deposit any amount of money, you can deposit $1 and you will get this promotion. What they are running right now is they will give you up to 12 free stocks valued up to $30,600. This is free money. You definitely don't want to miss it. So take advantage of this promotion. I will leave a link to the promotion down in the description below. The third dividend growth stock that we're going to look at today is AbbVie, stock ticker ABBV. AbbVie is a pharmaceutical company that was actually originally spun off from Abbott Laboratories. The company currently has a market cap of $245 billion. On the year, shares of AbbVie have eked out a small gain of roughly 2% on the year. For those of you unfamiliar with AbbVie, they have had the #1 selling drug for a number of years, and that drug is Humira. But they have already lost patent protection overseas internationally, and they will lose patent protection here in the US in the year 2023. To give you an idea on the early years of AbbVie, Humira accounted for over 70% of total company revenues. Fast forward to today, and Humira sales account for less than 40%. The reason we are seeing only 40% now, or less than 40%, is a couple of reasons. One, we lost patent protection overseas, but we're also starting to see many of those new drugs start to take shape and grow at a rapid pace. I have often referred to AbbVie as an investor's trifecta. Reason being, they offer high yield, strong dividend growth, and share price appreciation. Currently, shares of AbbVie yield a dividend of 4.1% with a payout ratio of 42%, meaning there is plenty of space for continued growth moving forward. The company currently has a 5-year dividend growth rate of 17.5%, and AbbVie has increased the dividend every year they have been a public company, which equates to 8 years and counting. AbbVie is an all-around solid dividend play. The fourth dividend growth stock that we'll look at today is Broadcom, stock ticker AVGO. Broadcom designs and develops semiconductor chips for companies all across the globe, and one of those companies is Apple. The company currently has a market cap of $186 billion. On the year, shares of Broadcom are down nearly 35%, and there could be plenty more pain where that comes from here in the near term. But one must remember that we are long-term investors looking for cash-flowing companies trading at strong valuations with strong cash flows. As technology and connectivity has evolved over the years, you can see Broadcom has done the same, with revenues climbing each and every year. Broadcom has connections to the following industries: cloud computing, Internet of Things, cybersecurity, and cellular, just to name a few. Broadcom has not been shy about building growth through acquisitions. More recently, the company announced the acquisition of VMware for $61 billion. Due to this, debt levels are certainly something to always keep an eye on when it comes to Broadcom. But one thing investors don't have to worry about is rising cash flows. Just look at the trajectory of this 10-year chart looking at free cash flow. It looks like an escalator moving up. Broadcom now generates over $15 billion of free cash flow, which is a major reason why they've been able to increase their dividend at such a strong clip over the years. Currently, shares of Broadcom pay an annual dividend of $16.40 per share, which equates to a dividend yield of 3.56%. The company has a 5-year dividend growth rate of 32%, and they have increased that dividend for 10 years and counting. The fifth and final dividend growth stock that we're going to look at today, one of my favorites, is Home Depot, stock ticker HD. Home Depot is the largest home improvement retailer here in the US with a market cap of $290 billion, which is actually substantially lower from where it was when it reached over $400 billion at the start of the year. On the year, shares of Home Depot are down 32%. However, Home Depot still continues to be the gold standard, operating on a very efficient manner. Home Depot saw a big boom during the pandemic when many were locked in their homes. Plus, they have a very strong presence when it comes to professionals. Right now, in particular, shares of Home Depot are under pressure due to the fact that they trade very similar to how the sentiment is around the real estate market. And right now, with mortgage rates increasing at a near 7% or over, mortgage applications plunging, and home prices now coming down as well. However, long-term, again, we are long-term investors. Home Depot is a blue-chip, high-quality company with a very strong management team. When you zoom out, you can see that how cash from operations have gone from mid-single digits to roughly $14 billion today. Looking at the dividend stats, you can see that the company has a current annual dividend of $7.60, which equates to a dividend yield of 2.7%. The company still has a very low payout ratio of only 45%, and over the past 5 years, the company has increased the dividend at an annual rate of 17%. In terms of consecutive dividend growth, the company has increased that dividend for 12 years and counting. So there you have it, 5 of my favorite dividend growth stocks to invest in for long-term gains. All of these companies have the opportunity for share price appreciation. They still continue to operate on a high level, producing strong cash flows, which lead to increased dividends. Down in the comments section below, let me know which of these stocks that we covered today is your favorite. And with that being said, I hope you enjoyed the video, and we will see you next time. Take care.